Every trader dreams of catching that one perfect move, that explosive candle that shoots in one direction with precision and power. But what most traders don't realize is that before every big move, there's always silence. The silence isn't accidental, it's engineered. That silence is what we call the consolidation zone, the battlefield where smart money and retail traders quietly prepare for war. Consolidation isn't just sideways movement. It's the language of indecision. It's where the market pauses to breathe, absorb liquidity, and decide which side deserves to be punished next. To an untrained eye, consolidation looks like boring, range-bound movement, just noise. But to a price action trader, especially one who studies smart money concepts, SMC, it's the most revealing part of the entire market structure, because it's during consolidation that the market sets its traps. A consolidation zone is a period where price moves between well-defined support and resistance levels, equal highs and equal lows, creating a range. This range represents balance. Buyers and sellers are momentarily equal, but balance in a market is never permanent. It's temporary stability before a deliberate imbalance. The market needs consolidation to build up orders, collect liquidity, and prepare for the next phase, expansion. Think of consolidation like a coiled spring. The tighter it coils, the stronger the breakout will be. The market is compressing energy, and once that compression ends, the release is violent. That's why understanding consolidation zones is one of the most powerful skills a trader can develop. Because if you can read what's happening inside the range, you can predict where the next expansion will go before it even begins. What really happens inside a consolidation zone? Every consolidation has three forces at play: accumulation, manipulation, and expansion. These three stages define the anatomy of every range, no matter the time frame. Accumulation is where the market breathes before it roars. It's the silent phase after chaos, when price moves sideways, volume dries up, and traders lose interest. But beneath that quiet surface, something deliberate is happening. Smart money is building positions, slowly, carefully, without leaving footprints. Every dip is bought. Every spike is sold into, creating a box that looks lifeless to the untrained eye. Retail traders call it no movement, but for institutions, it's the loading zone. They accumulate liquidity from sellers, absorb panic, and keep price pinned within a narrow range until they've gathered enough fuel for the next expansion. The beauty of accumulation lies in deception. It convinces most people that nothing's coming just before everything happens. You'll often notice subtle higher lows forming, wicks rejecting downside, and a gradual tightening of range, all signs that the market is gearing up for a breakout. Then comes the displacement candle, the explosion that confirms accumulation is complete. That's the shift from compression to expansion, from patience to aggression. And if you've been watching carefully, you'll know exactly where the footprints lead, because accumulation isn't random noise. It's the foundation of every major move that follows. Manipulation is the market's favorite illusion, the moment when truth hides behind movement. It's the phase where smart money shifts from silent preparation to active deception. After accumulation, when the crowd finally begins to notice a pattern, that's when the trap is set. The market pushes price just beyond key levels, above resistance, below support, triggering breakout traders and stop losses alike. To the untrained eye, it looks like confirmation. To smart money, it's collection. They lure retail in with momentum, grab liquidity, and then reverse the move with precision. Every false breakout, every sudden wick, every sharp rejection, that's manipulation in motion. It's not chaos, it's choreography. The market doesn't move against you. It moves through you, using your emotions as liquidity. Fear and greed aren't weaknesses, they're fuel for the system. The irony is that the manipulation phase isn't meant to hurt you. It's meant to prepare the path for expansion. Once liquidity has been taken and imbalance created, the real move begins. That's when the market finally reveals its intent. But by then, most traders are already trapped on the wrong side. The distribution zone is where the story quietly begins to end. It's the final act of the smart money cycle. The phase where big players unload their positions while the crowd still believes the trend will continue. After a strong bullish move, the market pauses, consolidates, and moves sideways. Not because it's uncertain, but because it's transferring ownership. What looks like another healthy pullback to retail traders is, in reality, a slow and calculated exit by institutions. Price keeps bouncing within a range, forming equal highs, enticing breakout traders to buy every push upward. But behind the scenes, liquidity is being gathered one last time. Each fake rally is a distribution point, each rejection a warning. Volume may look healthy, structure may look intact, but the energy is fading. The composite operator sells strength to the public while maintaining the illusion of demand. And when the last buyer steps in, the market finally collapses. The move down isn't random. It's the result of everything that came before. Accumulation built the base, manipulation set the trap, and distribution completes the cycle. What follows next is markdown, fast, emotional, and unforgiving. Imagine a market has been in a steady downtrend and finally starts to slow down. The candles begin to move sideways, forming a tight range. This is your accumulation phase. Institutions are quietly entering long positions here, while retail traders either stay out or continue selling, expecting more downside. You'll notice multiple touches on the same lows, equal highs and lows forming, and volumes slightly tapering off. That's your first clue that accumulation is happening. Then, out of nowhere, a sudden manipulation phase kicks in. Price drops sharply below the established lows, triggering stop losses of those who are long and encouraging breakout traders to go short. This sharp move is nothing more than a liquidity grab. Smart money using that pool of stop orders to fill their remaining long positions at discount prices. Once that manipulation wick is complete, watch what happens next. A powerful bullish candle appears, closing back inside or even above the accumulation range. That's your signal. This candle confirms that the liquidity grab is over and the distribution phase is about to begin. Your entry comes right after this confirmation, either on the close of that strong bullish candle or on a minor pullback to the broken structure. Your stop loss goes just below the manipulation low, because if price revisits that point, your setup is invalidated. Your target is the next liquidity area above, often the previous swing high or a clear imbalance level. In this setup, you're not predicting, you're reacting to structure. The accumulation showed intent, the manipulation created the fuel, and the distribution delivered the move. That's why it's such a powerful model. It's clean, repeatable, and rooted in logic. Now, for short setups. The ideal short entry appears when a candle closes below the high of the accumulation phase, confirming that manipulation has ended and distribution has started. This candle close acts as your confirmation signal that smart money has completed their liquidity grab and is now driving price downward. Traders can place their stop loss above the manipulation high, the fake breakout zone, to stay protected from further false moves. The take profit target can be set at a 1-to-2 risk-to-reward ratio or extended lower, depending on momentum. This setup demonstrates how understanding market structure and liquidity allows you to trade in sync with institutional moves rather than reacting emotionally to every breakout. The combination of accumulation, manipulation, and distribution forms a full cycle. The consolidation zone is not the market being indecisive. It's the market preparing. It's where the game of deception begins, where retail traders see boredom and professionals see opportunity. Every expansion you've ever seen, every major breakout, displacement candle, or parabolic move began in silence. The traders who can stay patient during that silence are the ones who get rewarded during the explosion. The consolidation zone teaches the greatest trading lesson of all, that the market doesn't move randomly. It moves with intent, and that intent is hidden behind stillness.